Industries that are hot, sectors set to outperform the market. That's what's here in Zacks Industry Rank Analysis. This piece is put together by Charles Roplet, our senior market analyst at Zacks.com. He has an industry rank analysis for us weekly where he takes a look at industries and sectors that are set to outperform, as we tell you in the open there. But this week we're doing something a little different because on his radar is not an industry or a sector. Matter of fact, it's estimate revisions that he's talking about. And I will just let you go ahead and explain it because estimate revisions are kind of going through a weird time right now, aren't they?
They are, and I actually titled this piece, "In a Recession, It's All Relative." And one of the things I wanted to get across people is I think sometimes it's very useful to share with the audience what I'm actually seeing and let them sit in my chair and look at the data the way I actually view it. And one of the big things I'm seeing out here is that a lot of the estimate revisions we're seeing right now are really a reaction to actual profits not being as bad as feared. And the first example I come up with, or actually show, is Research in Motion. 2 weeks ago, Research in Motion came out with a positive earnings surprise. They actually talked about growth in subscribers. Stock jumped immediately afterwards. Most of the covering analysts raised their expectations, and that's pretty important because Research in Motion has about 30 analysts following it. So when you see that large a number of analysts raising their estimates, it really says something. And in this case, when you look at Research in Motion, when you look at the earnings estimate trends going into the first quarter earnings report, into the quarterly earnings report, you actually saw estimates being cut. And the company had missed before, so there was this expectation that the company would miss profits again. And if you look at the broader backdrop, we're in a recession. There's increased competition from other smartphone makers, such as the iPhone, Palm's coming out with a new phone. Right. Certainly there's Microsoft Mobile. All these devices I know you're very familiar with.
Oh, absolutely. Not.
But, so you see all these trends and say, okay, Research in Motion is going to miss. And at this point, they came out not only surprising, but with a very bullish earnings report. And as a result, we saw all the analysts turn around, raise their expectations. Even our covering analysts here at Zacks came out and said it was a very good report. And the stock price jumped. Now, what's notable is that we've seen estimates being revised higher. And for those people wondering if they missed the boat, it looks like the stock could still go higher based on the trends of estimates. But this is a perfect example of where analysts were really fearing a bad scenario, and the scenario turned out to be good. Now, it's not the case universally. We've talked about the restaurants before. We're seeing same-store sales decline. I actually talked about 3 this week where they all came out and talked about how sales are still declining, but the pace of the decline is less than expected. They've done a better job of controlling margins than a lot of analysts were expected. So as a result, they pre-announced their quarterly numbers, or actually came out and said, guidance is going to be better than we first thought. Analysts are now raising their forecast as a result. So again, it's not that business is necessarily great for these companies, but when you look to relative what analysts were expecting, things are actually better. And so we're seeing a positive revision in earnings estimates, and that's a positive for the stock.
So, and you heard me ask you this at the roundtable the other day with regard to the stock market. I'll ask it here because I think it applies here as well. Should we be feeling good about this, or is this just another one of those things to make us feel less bad about what's going on out there?
I think it's something to make us feel less bad. It is a positive sign. We did not see the normal drop in the ratio of positive to negative revisions that we typically see between earnings season. As we move away from earnings season, in this case from fourth quarter towards first quarter, we typically see a higher proportion of negative revisions relative to positive revisions. That's a factor that you have fewer companies issuing positive surprises and more company warning. This time we did not see it. The ratio actually held pretty steady, which is in itself, it's a positive sign. It shows that we might be getting closer to turning the corner. And I've talked about this before, that when we look at the overall economy, the pace of the decline is slowing. The economy is still worsening. Certainly more people are losing jobs, but the pace at which things are getting worse is actually getting less bad, and that itself is a positive. And we're kind of seeing that with earnings estimates as well, where we're seeing the pace of cuts not being as bad as they were. Still seeing far more cuts than positive revisions, but we're starting to see things shift a little bit more in the direction we want them to be, and that itself is a small positive.
Quickly, you're highlighting three different industries here and three different examples: telecom, internet software, and the restaurant industry. Is this something that you're spotting in other industries as well, or just in isolated cases?
Yeah, I'm seeing actually across the board. Now, there are cases where we're actually seeing some good numbers coming out and businesses doing really well, but in a lot of industries, we're just seeing where things are less bad. And it's interesting because I talked about Black Rim right now, Research in Motion. And it's interesting. If you look at Nokia, we start to see analysts raise their estimates on Nokia as well. Still seeing some cuts on there as well, but we're seeing some analysts trying to look around saying, well, if this company is doing better, maybe that company itself might actually do better as well. And certainly it's important to realize that even in a recession, we typically see more companies top expectations than miss them during earnings season. So it's very possible when you look at past history of analysts maybe being a little too pessimistic relative to expectations, we could have an okay earnings season. Still not great numbers, still see negative growth overall, but maybe not as bad as we feared. And that itself, again, is a small positive.
All right. Do you own any of the stocks that you mentioned?
No, I do not.
All right. Charles does a very good job laying this all out for you in text version and text form. And if you want to see it that way, go to Zacks.com's homepage and scroll down the page until you get to the headline right under the green banner that says Industry Rank Analysis. It'll be the most current headline for this piece. Click on it and it'll take you right to it. With Charles Rotblatt, I'm Terry Ruffalo.